A 70% yield. Let that sink in for a second. If you put $10,000 into this ETF, the math says you'd collect around $7,000 a year in income. Sounds almost too good to be true, right? Well, in this video, we're going to pull back the curtain on MSTE, how it actually generates that yield, where the money really comes from, and more importantly, the risks that almost nobody talks about when they're showing you that headline number. By the end of this video, you'll understand exactly what you're buying if you buy this ETF, and whether it actually makes sense for your portfolio. Let's get into it. So what exactly is MSTE? It trades on the Toronto Stock Exchange under the ticker MSTE, it's managed by Harvest Portfolios, and it pays distributions every single month. But here's the part that matters most, MSTE holds shares of Strategy, the company formerly known as MicroStrategy. That's it, one company. This isn't a basket of 50 or 100 stocks like most ETFs you're used to. It's built entirely around a single, highly concentrated bet. And once you understand that, everything else about this fund starts to make a lot more sense, including that yield we just talked about. Here's where a lot of people get tripped up. When you see a yield that high, your brain naturally assumes it must be coming from company profits, or maybe a generous dividend policy. That's not what's happening here. The income from MSTE comes primarily from selling covered call options on those Strategy shares, not from any profit the underlying company is generating. In plain English, the fund is essentially renting out the upside potential of the stock in exchange for cash today. That's a completely different animal than a traditional dividend, and it changes everything about how you should think about this yield. Let's break down the mechanics, because once you see the four-step loop, the whole thing clicks. Step 1. The fund owns shares of Strategy. Step 2. It sells covered call options against those shares, basically selling someone else the right to buy the stock at a certain price. Step 3. It collects the premium, the cash payment, for selling that option. Step 4. That premium gets passed along to you as monthly income. It's a repeatable cycle, month after month. The genius of it is that it generates cash flow regardless of whether the stock goes up a little or stays flat. But as we'll see in a minute, that consistency comes at a real cost. Now here's the piece that explains why this yield is so much bigger than what you'd see from, say, a covered call ETF on the S&P 500. Strategy is an extremely volatile stock, largely because of its massive exposure to Bitcoin. And in the options market, volatility is directly tied to price. The more a stock swings around, the more valuable the option premiums become, because there's more uncertainty for the option buyer to pay for. So that eye-popping 70% yield isn't magic. It's essentially the market pricing in just how wild this stock's ride can be. Higher volatility literally is the fuel behind this yield. And this brings us to what might be the single biggest misconception about MSTE, and honestly about most high-yield covered call products in general. People see high yield, and their brain automatically translates that to high return. Those are not the same thing. Yield is just the income you're collecting along the way. Total return includes what happens to your actual capital, your principal, on top of that income. You can collect a massive yield every single month and still lose money overall if the share price falls faster than the income you're bringing in. Keep that distinction in your back pocket, because it's about to become very relevant. So what's the actual trade-off here? When the fund sells those covered calls, it's capping how much upside it can capture if the stock takes off. Covered calls generate income, but they limit your participation in a rally. So if Strategy shares suddenly spike sharply, which, given its Bitcoin exposure, absolutely can happen, MSTE gives up a meaningful chunk of those gains because it already sold away that upside for the premium. There's no free lunch here. Every extra dollar of income you're collecting is a dollar of potential growth you're giving up in exchange. Let's talk straight about the risks, because there are several stacked on top of each other here, and that's unusual even for the ETF world. You've got single stock exposure, meaning your fate is tied to one company's performance. You've got indirect Bitcoin dependence, since Strategy's balance sheet is deeply tied to Bitcoin's price. You've got leverage baked into the underlying company. You've got return of capital, which means some of what you're receiving each month might actually be your own money coming back to you, not real investment income. And on top of all of that, extreme volatility. Never invest based purely on the advertised yield without understanding this full risk stack sitting underneath it. Now let's look at what's actually happened in practice, not just in theory. Despite paying out those large monthly distributions, MSTE has experienced significant declines in its share price since it launched. This is the part that the yield number alone will never show you. You could be collecting steady monthly checks and still watching your account balance shrink if you're only looking at the income side of the ledger. Past distributions do not offset large capital losses. That's the single most important lesson from looking at real performance data instead of just the marketing yield. Over the past month, the ETF declined by roughly 50%. Looking at 6 months, the decline is also close to 49%. And since inception, investors have lost more than 60% of their capital based on share price performance. This is exactly why focusing only on the distribution yield can be misleading. Imagine collecting a very large monthly income while your investment continues losing value. In that situation, your total return may still be negative, even though the cash distributions look impressive. That's why professional investors always evaluate both income and capital appreciation together. The real question isn't, how much income am I receiving? It's, am I actually growing my wealth over time? This comparison is one of the most useful ways to understand what you're really choosing. If you just buy strategy shares directly, ticker MSTR, you get full upside potential, no cap on your gains, and higher long-term growth potential, but you get no monthly income and you're taking on higher volatility with nothing smoothing it out. If you buy MSTE instead, you get monthly income, but your upside is capped, the structure is more complex, and you're still carrying that same single stock and leverage risk underneath it all. Neither option is automatically better, it genuinely comes down to what you're trying to accomplish. Choose the investment that actually matches your strategy, not just the one with the bigger number on the label. Let's also compare MSTE to the covered call ETFs you might already be more familiar with, like JEPI or JEPQ. Those funds own diversified portfolios, dozens or even hundreds of underlying stocks. MSTE, on the other hand, concentrates its entire strategy on one single, highly volatile company. That's a fundamentally different risk profile. With JEPI or JEPQ, if one company in the portfolio has a bad quarter, it barely moves the needle. With MSTE, if strategy has a bad quarter, you feel all of it. Diversification is what reduces company-specific risk, and MSTE, by design, gives up that protection entirely. So who does this actually make sense for? Realistically, this is a product built for experienced investors who already understand options, who already understand Bitcoin's volatility, and who are specifically hunting for high monthly income and are comfortable with the swings that come with it. This is not a fund for beginners, and it's not a fund for conservative investors who need stability or who are close to retirement and can't stomach large drawdowns. If you're still building your foundational understanding of investing, this is probably not where you want to start, and that's okay. Knowing what a product is not for is just as valuable as knowing what it is for. Let's say you've weighed all of this and you still want some exposure. The way most experienced investors approach a product like this is by treating it as a small satellite position, not a core holding. Think of your portfolio like a solar system. You've got your core holdings acting as the sun, the stable center everything else orbits around, and then you've got smaller satellite positions like MSTE that add some extra income potential without being able to sink the whole ship if things go sideways. Position sizing is just as important as which security you actually pick. A great choice at the wrong size can still hurt you. So where do I land on all of this? MSTE isn't a scam, and it isn't a miracle either. It's a specialized, high-risk income strategy doing exactly what it was designed to do. The problem isn't the product itself, it's when people buy it purely because they saw a big yield number without understanding the mechanics underneath it. If you understand covered calls, if you understand the Bitcoin exposure sitting inside strategy, and if you're using this as a small, deliberate piece of a much bigger portfolio, it can absolutely have a place. But understand the strategy before you chase the yield, not after. Let's bring it all together. Yield does not equal return. Those are two completely different numbers telling you two different stories. Take the time to actually understand how covered calls generate income before you buy in. Expect high volatility, because that volatility is literally what's fueling the yield in the first place. Focus on total return, not just the monthly income hitting your account. And above all, invest with a clear strategy, not just a reaction to a big number on a screen. A great investment starts with truly understanding what you own, not with how attractive the yield looks on the surface. If you found this breakdown helpful, consider subscribing for more honest, no-hype breakdowns of ETFs like this one. And as always, this video is for educational purposes only and isn't personalized financial advice. Do your own research or talk to a professional before making any investment decision. Thanks for watching, and I'll see you in the next one.